Have you ever felt like traditional accounting is a lot like driving a car while exclusively staring into the rearview mirror? I mean, sure, it tells you exactly where you've been, how much gas you burned, and every single bump you hit along the way. But it doesn't tell you a thing about the road ahead. Well, what if accounting could act as the windshield instead? What if it could help you anticipate those sharp turns, avoid the massive potholes, and actually chart the absolute best route to your destination?
Welcome to The Explainer. Today, we're totally transforming the way you look at business finance. We are moving from hindsight to foresight by exploring the incredibly dynamic world of management accounting. We're going to see how basic compliance tasks and raw numbers get converted into a literal strategic superpower, one that drives long-term business success.
Here is our roadmap for today. First, beyond the balance sheet. Second, the engine of decision-making. Third, management versus cost accounting. Fourth, tools of the trade. And finally, fifth, the manager's secret weapon.
Section 1. Beyond the balance sheet. The true meaning and scope of management accounting. All right, so when most of us hear the word accounting, what pops into our heads? Probably tax season, right? Or maybe strict legal compliance and those giant dusty ledgers. But management accounting operates in a completely different universe. To really ground this, let's look at how the International Federation of Accountants defines it. They call it the process of identification, measurement, and communication of information used by management to plan, evaluate, and control. Notice those active, forward-moving words in there? Plan, evaluate, control. It's not just about accumulating numbers, it's about accumulating meaning. It takes the raw, historical data generated by your company and basically shapes it into a clear lens to help you navigate the future.
So the real takeaway here is that management accounting is a continuous, forward-looking process, and it is highly selective. A management accountant doesn't just, hand the CEO a massive stack of every single transaction that happened last month. They actively filter the data, pulling only the relevant financial and cost information needed for a very specific strategic decision. And here is a wild twist. Because this information is built purely for internal strategy and top-level managers, it doesn't even have to follow strict statutory reporting standards like GAAP. It's custom-built for whatever the business needs at that exact moment in time.
Section 2. The engine of decision-making. Objectives and workflow.
So why does an organization literally need this to survive? Well, profit maximization doesn't just happen by accident, does it? The primary objectives of management accounting cover the entire life cycle of business management. It starts with planning and formulating policies, using past trends to forecast the future. It interprets complex financial data by turning it into simplified charts and graphs that executives can actually digest without getting a headache. It enables scientific decision-making, meaning you're backing up your choices with actual data, not just, a gut feeling. And importantly, it controls performance. By assigning specific budgets to different departments, it allows a company to spot exactly where things are going off track and actively course correct in real time.
Now, what's really fascinating here is the structural breakdown of these functions. On the input side, you've got the raw mechanics, recording, modifying, analyzing, and communicating data. But take a look at the execution side. That information directly fuels management action, planning, organizing, coordinating, controlling, and decision-making. Management accounting is essentially the bridge between raw data and executive action. It assesses the risks, it measures employee and departmental performance, and it even tracks the impact of outside economic forces.
Let's put you in the CEO's seat for a second so you can see this workflow in action. First, your management accountant compiles the historical data from your financial and cost accounts. Second, they perform a cause and effect analysis. They don't just walk in and say, hey, profits are down. No, they show you that profits are down because raw material costs in one specific region unexpectedly spiked. Third, they help coordinate a master budget to adapt to this new reality. And finally, they help you take corrected action. It's an active, living, breathing process.
Section 3. Management versus cost accounting. Understanding the vital differences.
Okay, a lot of people tend to confuse these two pillars, but there's a huge philosophical difference between them. Cost accounting is generally historic and short-term. Its main goal is to figure out exactly how much it cost to produce a widget yesterday so you can try to control your costs today. Management accounting, on the other hand, is futuristic and long-term. It takes that cost data, combines it with all sorts of other financial information, and asks the big question. Based on these costs, should we even be making this widget next year, or should we pivot to a totally new product?
When we look at the day-to-day operations, the differences become super clear. Cost accounting is used heavily by middle and lower management. It relies strictly on hard, quantitative numbers. Its main objective is cost control, and hey, in some industries, it's actually legally mandatory to do a cost audit. Management accounting is the tool of top-level management. It blends that quantitative data with qualitative insights. Its objective is high-level policy formulation, and nobody legally forces a company to do management accounting. They do it because it's, frankly, the only way to survive and thrive. Cost accounting precedes management accounting. It essentially provides the raw ingredients that management accountants use to bake the strategic cake.
Section 4. Tools of the trade. Techniques used by management accountants.
So how exactly do they pull all this off? Well, management accountants have this massive arsenal of techniques to translate data into strategy. Let's start with a big one, standard costing. This acts as a vital control mechanism. Basically, the company sets a predetermined standard cost for an activity, say producing a pair of shoes. Then they measure the actual performance against that standard. The real magic happens when you analyze the variances. If the shoes cost 20% more to make than the standard costing helps identify the specific responsibility center, the exact department or machine where things went off track so management can take immediate remedial action.
Now, standard costing is often confused with budgetary control, but they actually serve completely different purposes. While standard costing focuses on the cost of making that specific pair of shoes, budgetary control zooms way out. It involves setting a specific financial budget for the entire shoe manufacturing department or other organizational units. Management then evaluates the overall performance of those departments against their budgeted values. It just ensures every distinct part of the company is financially aligned with the master plan.
Next up, we have marginal costing. This one is an absolutely crucial tool for those immediate tactical choices. It works by strictly dividing costs into fixed components, like the rent for the shoe factory, and variable components, like the raw leather and rubber. By isolating those variable costs, managers can make lightning-fast decisions on the selling price of a new product line, determine the absolute most profitable sales mix, or make the classic make or buy decision, calculating whether it's actually cheaper to manufacture the shoelaces in-house or just buy them from a supplier.
Beyond those three, the toolbox is just massive. We're talking financial planning to figure out capital structures. They use fund flow and cash flow analysis to assess liquidity, making sure the business doesn't just look profitable on paper, but actually has the cash in the bank to survive. They utilize ratio analysis to quickly judge solvency and profitability, cost-benefit analysis for testing out new projects, and even advanced statistical analysis to draw logical conclusions from giant datasets. It is a highly analytical, rapid-fire toolkit.
Section 5. The manager's secret weapon. The advantages and overarching roles.
When you combined all these tools and workflows we've talked about, what's the actual impact on the life cycle of an organization? Well, management accounting doesn't just inform decisions, it justifies them with hard data, drastically reducing leadership risk. It enables continuous, rolling future planning rather than just waiting around for an annual report. By actively identifying and removing deviations, it completely transforms organizational efficiency and ensures optimal resource utilization, saving tons of wasted capital. And here's a really overlooked psychological benefit. By setting clear, data-driven standards and budgets, it actually motivates employees. When people have clear expectations and fair responsibility centers, performance just naturally improves.
Ultimately, you can think of management accounting as the steering wheel of the entire enterprise. While financial accounting is busy documenting the past for external regulators, management accounting is down inside the ship, assessing internal risks, allocating scarce resources to the most profitable projects, and constantly adapting the company to external economic, social, and governmental forces. So, I'll leave you with this final thought to chew on for your own projects or organization. Look at the numbers you rely on every single day. Are you simply recording history and tracking your costs? Or are you actively using that data to drive your business forward? Embracing the tools of management accounting is the ultimate shift from being a passenger in your business to becoming the driver. Thanks so much for joining me on this explainer, and I'll see you next time.